Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, "The ultimate in real estate is being the bank." And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday?
How y'all doing? Pumped. A lot of familiar names, a lot of new names. How many of you guys, this is your first time here with us? This is your first Take Back Control Tuesday webinar. I love the hand raising. Yep. How many of you guys, you've seen and been a part of our campfire for years or maybe months? I know there's a few of you guys I saw. A lot of hand raising for first though. This is your first time being here. This is exciting. Shane, going on 3 years. This guy's an expert. You guys have questions, don't go to me, go to Shane. He'll help you out. Everybody, I assume you guys saw Chris Naugle on social media, on YouTube, somewhere, learning about infinite banking, learning how you can become your own bank, and that's what led you to this presentation today. So we're excited for you guys to be here. This presentation is going to be fantastic. It's going to be a little bit different. So some of you who have been here for a long time, this might be a little bit different than what you've seen. But those of you who are here for the first time, this should be a great place for you to start learning about infinite banking. So I would like for you guys today to be super interactive. I always say this because it's important. The more you guys interact on the chat, the more you guys let us know your thoughts, feelings, your questions. Throw them in here so we can all communicate together and we can help you guys learn better. The more you communicate, the more you're interactive, the better the more you're going to get out of this. And those of you who are calling in, watching this from work or your lunch break, we are glad you guys are here. If you guys are at home, ready to dive deep into this stuff and study this with us, we're excited for you guys too. So that being said, I want to start with a question today. How many of you guys are business owners? You got a side hustle? You're an actual business owner? Throw us in the chat, let us know. Some business owners. Yeah. Well, whether you own a business or you don't, let's imagine you owned a business, but a very specific type of business. Let's say you owned a restaurant. If you owned a restaurant, where would you want your restaurant to be? What part of your town would you want it to be in? You can close your eyes and imagine it. Where would it be? What kind of cuisine would you serve? Where would it be? Would it be fine dining? Would it be fast food? If you guys had this restaurant, what would you want this to look like? Now, if you guys were out one night, late with your friends and your close family members, where would you guys go out to eat? Would you guys go out to eat at this beloved restaurant of yours, or would you go out to your competitors or somebody else's on a late night? You take them to your place because you got pride in it. Next question though, what if you guys owned not a restaurant, but a salon or a barber shop? You guys owned your own place. Would you guys go get your hair cut at your barber shop or salon or somebody else's? Absolutely, you'd go to yours. You wouldn't go to anybody else's. And if you guys, of you who do go to the gym, do you guys ever go to the gym and see the gym owner not working out at their own gym? They're always at their gym. They're not somebody else's gym working out. And last question for you guys. If you owned a bank, would you make deposits in your bank or somebody else's, Bank of America or Wells Fargo? If you needed a car or a house, or you're going to do rehab on a home or something, would you guys get that loan from your bank or somebody else's? And if you did take a loan from your bank, would you pay your bank back with principal and interest? Absolutely you would, because you wouldn't steal from your bank, just like you wouldn't steal from your business. So why don't all of you today have your own bank? It's because we haven't learned yet how to do that. And that's what I want to talk about today is this 200-year-old strategy that's been used by the wealthiest families across history to minimize their taxation, to eliminate debts, and to not just build wealth for themselves, but generationally. And so this strategy today is going to be all about you guys and how you can become your own bank. Now, often when I talk about this strategy, there's one thing people ask about. It's well, sure, it's been around for 200 years, but who's been doing this? What's the credibility behind it? And there's been a lot of people who have used this strategy. People like the Rothschilds. If you don't know who they are, look them up. Or Mr. John Rockefeller. You all probably know this last name, Rockefeller. He used this strategy to build not just wealth for himself, but wealth to even his kids, grandkids, great-grandkids, and his generations even today alive are extremely wealthy because of what he did using this strategy. Next is Mr. Ray Kroc. You guys know what business Ray Kroc started? McDonald's. And is McDonald's in the business of flipping and selling burgers, or what business are they in? I think they're in the business of real estate. And how did they start this business? Right? Through this strategy. We'll get to it. And last, Mr. Walt Disney. You guys all know him. He started his company when he was dead broke in the Great Depression through this strategy. And actually, most recently, you football fans out there, you guys know Mr. Jim Harbaugh. Jim Harbaugh was the University of Michigan head coach. And when he got his last contract with them, he incorporated this strategy into his contract to ensure not just himself, but his kids were wealthy and well off forever as well. So how are these individuals doing it? And how can you implement it? And today we're going to talk all about what this is and how we do it. And so to give you guys a quick intro, just so you guys who are new here today and don't know who I am, I'd love to give you a quick introduction of who I am so you guys have some confidence in your speaker today. But real quick, these are some photos of my wife and I. Again, my name's Carson Herleen. I live in Southern California, and we love life. We travel a lot. We live by the beach. We surf, and we've built over the past few years a foundation for our young family to not just be rich, but to build generational wealth. And I can sum this whole experience up with two words. One being choices, and second being gratitude. Choices, because I get to choose every single day what I do. If Anna and I wanted to get up and go to Europe, we could. We have so much freedom over our lifestyle and our time, and that's bled into our finances and our life, and it's wonderful. And I say gratitude because I get to feel secure and confident in my financial future. But more than that, I'm grateful for the opportunities I've been given. I've been given so many mentors in my life that have guided me in the right direction to start my career, and I'm really grateful for that. But my story is actually, I'd say, pretty simple, and I'm sure a lot of you actually can relate to it. In my early years, I made a lot of mistakes, as you know, we all do when we're young. But when I was 18, I went on a service trip where I lived abroad, and I served people for a year. And when I came home and I was in college, I had a lot of outside influences pushing me in different directions. And in one hand, I held the traditional route and mindset. I was learning about, schooling stuff, math, economics. I was really being groomed to go into corporate America. And in this other hand, I was around entrepreneurs and real estate investors, business owners, and I saw the freedom and control that they had in their lives. And I had to decide, which route do I want to follow? Do I want to continue to work for money and kind of be a part of the rat race, or I want to learn how to make money work for me? And it was that tension pulling these two ideas apart that brought me to a point of decision. And the decision was to drop out of school and actually pursue an education in investing and learning how to make money work for me. And that changed the course of my life. But above all, what's most important to me is family. And I'm sure that's the same for a lot of you guys too. And so today I want to talk about you guys and your families, your goals, and what you're looking to accomplish, because what we're going to teach will hopefully help you get to those goals. And when I was learning about money, I spent a lot of time studying different things, but one question popped up, and it made me really think about it. And this question might not be something you guys think about often, but I'm going to ask you guys to. So take a look right here is my first question for you. Could it be possible that there are more efficient environments to store wealth outside of commercial banks that you're not aware of? Think about that. That should be a yes for most of us, but it's a powerful question because what I want you guys to think about, you're probably already not thinking about, and what you haven't been taught to think about. And I hope when it comes to money, we can kind of have a humble learner mentality throughout our life. And a lot of you guys have read business books like Rich Dad, Poor Dad, Money Master the Game, and those type of business books. And what is one law that everybody follows and everybody teaches? It's to save money. You can't do anything without saving money or keeping the money you make. And a lot of people say save at least 10% of your income. And I hope most of you can at least do that at the bare minimum. But in today's economy, the average American saves about 3-4% of their income. It's just not enough. And in our American culture, we don't value savings. We don't value control over our dollars. And why is that? I'm convinced that the reason we don't save money is because the environments we've been told to store money are so incredibly inefficient, it makes us hard to want to. These environments like savings accounts, high yield savings accounts, 401ks, they're so inefficient that it makes it hard for us to save money and for us to want to. And sorry, I should have put this up earlier. I was just going off on my tangent here. But when we're talking about these environments to store money, if we want to become our own bank, we need to find a place we can store our funds that we can control and they can be efficient. And so what I want to talk about now is your bank that you are setting up. What is your bank? And this bank you're going to set up, this is going to be where all of your banking activities happen. And if you were to look up what banking meant, you look up banking, it says banking is the business of protecting your money. Interesting, right? If you look up the act of banking, the verb form of the word, banking is depositing money, lending money, and protecting money. So why are we doing all three of those things with other people, with other banking organizations? With this strategy, we're going to find a way to control all three of those banking activities in our life. And when you guys really start to understand how banking affects every single component of your life, it's going to change the way you see money. And so throughout this presentation, I ask you guys to have an open mindset around this concept. And again, I told you we're going to set up our own bank, right? And so what is this bank? Well, what if the bank you were going to set up was going to replace your current bank at somebody else's place? Anytime you ever needed to buy something or invest in something, it would come from and to your bank. So let's just start real quick with a few attributes of what your bank is, okay? I'm going to compare your bank to a traditional bank, to another place you could store money. You have the option every single day where you put your money, where you deposit it. You could choose to deposit it in somebody else's bank, or you could choose to deposit it in yours. Well, here's what your bank will be. Liquid. That's the only attribute traditional banks have. It's great. Your money's sitting there and it's liquid. That's what it's meant for. And that's what it will be in your bank as well, because we all need liquidity. We can't not have liquidity or else we can't live our lives, right? So we need liquidity. Second, it's going to grow. What if your bank was going to grow 2, 3, 4, 5, 6%? And what if that was guaranteed, uninterrupted, and compounding? These are big words, but they're all very important words. Traditional banks, the average savings account across America right now is 0.07%. And you're even taxed on that tiny interest rate you make. Whereas what if your policy grew tax-free? Sorry, I'm already giving you a heads up, but what if your bank grew tax-free? And on top of that, what if it was protected? What if it was protected against lawsuits, judgments, liens? And while your bank that's sitting with Wells Fargo or wherever else you store your money is unprotected, banks go bankrupt every single year. In 2009, 360 banks went bankrupt. That does not seem like a safe place for money to be. And last, stable. During times of economic uncertainty, wouldn't it be nice if you could count on where your money was being stored? And if the place you chose to store your money had all of these attributes, wouldn't that be an efficient place to store your money? This would be a place you could control, you could count on, you could use as the foundation to finance everything throughout your life. And I get it too, because we all have crazy lives. We all got a lot going on. Some of those of you who are business owners, it's probably even more chaotic. But the opportunity you actually would get with this strategy to put money somewhere that was, again, liquid, guaranteed to grow, tax-free, and safe from the world, the market, the economy. And if I was to add to this, if you did take any money out of your bank, it would actually not stop the compounding. That's something every American should be diving deeper into to understand why this is the way it is and how they can implement this. So wouldn't you guys agree? If you could store your money somewhere that had all of these things, you would, right? In the chat, what do you guys think? So let's get into what this is and what we're actually going to use to be our own bank. Okay? And this machine, this vehicle we use to be our own bank is just a vehicle, meaning it's just a place your money runs through. It's not a place you set your money one time and let it sit forever and leave it and let it be static. You want to keep your money moving. And so the vehicle is just that. And if we're going to change one thing in our life, which is all this strategy asks of you, is to change one thing. And that one thing is where your savings, the money you keep, goes. It's going to go into this vehicle instead of other vehicles. And before I tell you what this vehicle is, I want to start with a quote by Mr. Will Rogers, who says, "The problem in America isn't so much what people don't know, it's what people think they know that just ain't so." So don't judge this when you first see it because you might not understand it, but we're going to help you get there by the end of this presentation. This is nothing other than a dividend paying whole life insurance policy from a mutual company. Now, before you guys leave the webinar because you hear life insurance is horrible, stop for a second and let me explain to you. This is not normal life insurance. This is specially designed and engineered life insurance. This policy will end up looking more like a supercharged bank account than life insurance itself. And yes, it has all those attributes we just talked about. You just haven't been taught how to use life insurance to do that. And this is not, again, like the life insurance you hear Dave Ramsey or Susie Orman's talking about on the news or social media. This is not like that either. Again, this is specially designed and engineered whole life, just like the Ford Focus in the dealership. Okay, do you guys ever go to a car dealership, maybe a Ford dealership, and you see a car like this? Nothing wrong with it, just a simple car. It's fine, right? Nothing crazy. But let's say you go home, you're on YouTube looking up these type of vehicles. This is a Ford Focus. And you see Mr. Ken Block going 140 miles an hour, drifting around a turn in this Ford Focus. What's the difference between that first Ford Focus and this one? Design and engineering. So again, this is specially designed and engineered life insurance. And when people, well, I guess when I was first learning about this, I probably didn't even believe this at first. I think I kind of did, but I didn't fully get it. And I think the reason that was because what people were telling me about life insurance. When you first learn about whole life insurance, or you guys might have preconceived thoughts already today about what whole life insurance is, you would think, whole life can't do that. It doesn't have those attributes. It's not growing. It's not safe. I mean, what I hear when I hear life insurance is I hear these things. The common sayings are, oh, it's got a low rate of return. It's expensive. It's the worst investment of all time I've even heard. And you guys might be thinking whole life is that too, or it doesn't work this way that I'm teaching. Well, if you guys are taking notes today, I ask you guys to write this down. If anything, if you take anything for the day, take this. It's that whole life insurance is not an investment. It's not. If whole life insurance is actually a separate asset class than investing, and it's considered a permanent life insurance that has guaranteed cash value growth. Investments have risk. This has no risk. It's guaranteed. So this is not an investment. And when you guys go home and talk to your spouse or your business partner or a friend about, hey, I'm going to do this whole life thing and I'm going to be my bank and all this stuff, the first thing they're probably going to tell you is, don't do that whole life thing. It's got a low rate of return. It's expensive. It's the worst investment. You now know that individual you're asking about has no idea what they're talking about because they can't even correctly identify what type of asset class that it is. So guys, listen to people who know what they're doing and who follow what banks do and what wealthy people do and understand that life insurance is not an investment. And when we talk about investing and banks, we talk about how we want to become like the banks. And there's actually a book written on this strategy by Mr. Nelson Nash. This is the book title on the left. It's a fantastic book. Every single one of you should read it. You should go get it right now if you don't have it. But this book teaches you this strategy in a very in-depth way. But he says the problem in America is that you finance everything. You finance everything in your life. Well, and why is that bad, you might think? Why is that bad to finance everything? Well, you either buy something by borrowing from the bank and paying them interest on the money, right? That's one way to purchase something or finance something. The next option you have is save up money in somebody else's bank, so they're leveraging it. And then when you have enough in there, take it out and buy something cash. Well, guess what? Now you just lost all that money. You lost the ability to earn interest on that money ever again. That is also called an interest cost. So whether you get a loan from the bank or you save it up and spend it, there is an interest cost attached to that amount. And the problem is we're doing all of these financing with other people. So this is why, whether you pay cash or finance, the bank is at the core, collecting, controlling, and making insane profits off of all the hard work that we're all doing. This is why we and you need to become your own bank so you can control all these transactions and you can be the one earning interest always. And what's actually really funny is you guys earlier, I told you how other individuals and families have been using this strategy for a long time and all that. But you actually know who the number one purchasers of these specially designed policies is. It's banks. You can look this up. BOLI, bank-owned life insurance. Banks actually are the number one purchasers of these whole life policies in the world. Crazy, right? You probably didn't know that. Between these four banks alone, these four big banks, there's over 60 billion in whole life. And they have more whole life than they own in land and buildings combined. So why is that? Why do banks want whole life? And not just want it or have it, they buy more every single year, which is the crazy part to me. I don't know how they have enough to do that, but they keep buying more and more. And so we all know banks are not stupid. And we probably have to ask ourselves, why are banks doing this? Are they stupid, or do they just know something that we don't know? They're not. They're smarter than I am, smarter than you are. We just need to mimic them. We just need to do what they're doing. So what are they doing? Well, I'll show you. Let's say you had $100,000. You can use whatever number you want, 1,000, 10,000, 100,000, and you leave it at the bank. Let's say you have a really, really great bank. They're paying you 4% on your savings account. That's probably unheard of right now. It was around a couple years ago, but probably not right now. Say it's 4% you're earning. You're pumped about it. Okay. Well, what's the bank going to do? That money sitting with them is a liability, not an asset. So they need to turn that into an asset. They're going to go lend it out to somebody else. They'll lend it to somebody down the street from you, maybe, who's going to buy a house with the mortgage at 7%. And when they close on that home, they're going to pay the seller. And where's the seller going to put their money? Back in the bank. And the bank's going to lend it out again to somebody else. Maybe a car note, 8%. Who's going to pay the car dealership? Who's going to put the money again? Where? Who will probably lend it to somebody else on a home remodel loan, possibly at 9%? Who will pay their contractor? He will deposit the money back in the bank? Maybe the contractor has some debt and needs a debt consolidation loan. He'll get a debt consolidation loan at 12%. They'll pay off the credit cards and they'll put the money back in. So guys, who's in control of all these transactions? The bank, right? Easy. While you're making 4, they're making 7. They're making a 3% spread. While you're making 4, they're making 8. They're making a 4% spread. While you're making 4, they're making 9, a 9% spread. Or sorry, 5% spread. While you're making 4, they're making 12, an 8% spread. If you total all of those up, they are making 20%. If you're making 4 and they're making 20% more than you are, how much more are they making? Not 16%. They're not making the spread. Banks are making 20% more than you, which means 4 goes into 20 5 times. So the bank's making 5 times more than you. They're making 500% on your dollars while they're sitting there every single year. You actually can look this up. BauerFinancial.com, you can find out. You can read any bank's actual annual reports and you will see that banks make between 400 and 1,300% on the money that you leave there each and every year. So earlier when I told you guys that these banks are the number one purchasers of these specially designed whole life policies, the thing I asked was, are banks stupid or do they know something you don't know? You probably should now know banks are not stupid. They know something we don't know. So in order for you guys to fully understand this, I'm going to share with you one more thing, one more example, and it's going to be about compound interest. So how many of you guys, and this is where you guys can actually chime in the chat. Let me know your thoughts. Would you guys rather have $1 million in hand today or a penny that doubled every day for a month? $1 million a day or the penny for 30 days? Everyone is smart. They know exactly where I'm heading. the penny, right? Every single one of you. I didn't get anybody. Someone's got to say they want the $1,000,000. Sounds like a lot of money, right? All right, well, you guys are right. Penny. So we all want a penny. Okay. Penny doubled every day for 30 days. Here's the math. Penny to 2 pennies to 4 to 8 to 16, 32, 64, 128, 256, all the way down to 15 days. Back up on the right side of the column, 16 days. Keep doubling down for 30 full days. 30 days goes by, the penny turns into $5.3 million. That's a whole lot more than the $1,000,000 you would have got up front. So good job, guys. You knew. So this is the power of compound interest if you just let your money sit there and do its thing. Now, I want to share a couple more examples with you, though. What if it was compounding, but there was a 2% fee attached to it? 30 days goes by, it only grows to 2.9 million. 2.9. So remember, it would have been 5.3. In this scenario, it's only 2.9. So that 2% fee just eliminated over $2 million of profit. Is that really 2% of 5.3 million? Or does it seem like a little bit more? Or a whole lot more? Well, what if no fees? Let's say maybe you took out $100. You withdrew $100 during this compounding cycle on the 15th day and the 25th day. Okay, just $100 comes out. So $200 over the full 30 days was withdrawn from this compounding. Just $200 only grows to 2 million. That $200 withdrawal cost you over $3 million of compounding. I'll give you one more example, taxes. All of you probably pay a higher tax rate than 15%. Maybe 15% is an accurate rate. If you're taxed 15% on each time it compounded, you only would end up with $500,000 after 30 days. And the crazy part is actually you only would have spent like 180 grand in taxes. That's it. But that 180 cost you, what is that? A little more than $4 million, 5 million, almost $5 million. So that's extremely, I guess that's really affecting your compounding. The fees, the withdrawals, the taxes. You know what's funny about this is how many of you guys here today put your money somewhere that has all three of those things stopping you from compounding? There's a small fee for somebody managing it. The tax is always going to be there and someday you'll have to pay it. And sometimes you tap into that account and you withdraw money out. And we wonder why we can't get ahead and why Americans suck at saving and growing their wealth. Guys, uninterrupted is the key word. Uninterrupted compound interest can be so efficient and powerful in your wealth building journey if you just let money sit there and do its thing. But how can we do that? Where can you do that? Who would actually let you put money somewhere without those three things? You guys on the chat today are probably smart. You guys probably know these specially designed whole life insurance policies do just that. Your dollars sit and compound always. So now that we've kind of laid the framework of the power of life insurance, the credibility behind using whole life, this is not just some scam on the internet. A lot of people have been using this for centuries and still do today. What banks do and how they actually operate, why you'd want to even become the bank, and now you understand compound interest. So let's go put this into action so you guys can actually understand how this works with real life examples and numbers. And I'm going to share my first example of buying a car. Because buying a car, super easy. We all get it. We all do it. It'll be something for us all to kind of understand the strategy with. So I'm going to show you guys how you can get all the money back for every car or truck you ever buy, drive, or own the rest of your life. Okay? And on this right side here is a photo of a policy example. Don't dive too deep into it yet. I'm going to share it with you in 1 minute. But first, I'm going to talk about 3 things that have to do with this policy, okay? Number 1 is premium. When you guys hear premium, you think that is a bad word. You hear home insurance premium, car insurance premium, health insurance premium. Premium is a bill, it's an expense. It is not yours or helpful to you in any way. And that's probably how you see life insurance premium. And you might even have old life insurance policy premiums you pay right now, and that's how you look at it. And that's probably the way you should look at it. But remember, if this policy is liquid and available to you, then it's a deposit. It's no longer a premium. It's just a deposit into your account. I've never seen somebody want to deposit less money in their savings account because it's liquid there too. So why would you not want to deposit more money in this savings vehicle? It's still liquid. And you might actually be thinking you need a lot of money to do this, right? You don't. This example I'm going to share with you is somebody who could only save 10 grand a year. That was 800 bucks a month. And you might be thinking maybe even you're too old to do this. Well, you're not that either. You can do this at any age. We've had people set up policies when on their brand new babies, and people set up policies in their 60s and even early 70s. So no, age does not matter. And the reason it doesn't matter is because I'm not building this policy for the biggest death benefit possible. Because if that's the case, yeah, you're right. Age probably matters. I'm building this policy for as much cash value as possible and for the banking abilities to finance things through our life through somewhere we can control. And if that's the goal, then the death benefit is not important. We're happy it's there. This is life insurance. You will have a death benefit, but we're not specifically doing this for the death benefit. Now that we're on the same page of kind of how we look at this, let's look at the policy and how we use it. So this example, this guy was saving 10 grand a year, like I mentioned. So he deposited 10 grand a year into his policy. First 7 years of the policy, he paid 10 grand in every year. This cash value over here on the right side, this cash value is what is liquid and available to him. Year 1, 10 grand goes in. He has access to about 6 grand. Year 2, 10 grand goes in. He has access to about a total of 12 now in year number 2. Year number 3, it drops to 4. The reason it drops to 4 is because he takes $25,000 out to go buy a car. So he takes 25 grand out of his cash value from his policy and goes and buys a car. Now, when you take money out of your cash value in life insurance, it is a loan against the policy. And if you're going to take a loan from yourself, shouldn't you pay yourself back with principal and interest? Just like if you got a car loan from another financing company, you'd pay them back every month faithfully. So let's do the same thing to ourselves. Let's take a loan from ourselves to buy this car and pay ourselves back. And while we are taking a loan against ourselves, your deposits, well, you're paying into this policy. Remember the attributes I showed you in the beginning. It's still going to earn interest, guaranteed, tax-free, and it's going to be now uninterrupted because you're not taking 25 out and stopping the compounding. You're letting it still sit there and compound. You're going to, by using the policy as a place to store your money, it is now going to be uninterrupted and compounding forever. And when you do take money against this, it's going to be a loan against the policy, which means your dollars, again, still sit and compound. And don't forget, you still have a death benefit while you do this. Cherry on top of this. So you take 25 out and you pay yourself back 500 bucks a month, just like any other car note. 500 bucks a month, 60 months. That is about 6 grand a year for 5 years. So let's sum this up real quick. Just one simple example of buying a car. You've paid 70K in premiums. You've paid back 30,000 in repayments to yourself. So you've put in 100 grand into this thing. It's a good chunk of money. Over 7 years, 100 grand has gone in. You've also taken out 25 to go buy the car. So really your net injection into this thing is 75. So you've put in $75,000. Well, look at the cash value, 67,000. You have access to 91% of the money you put into this. 67,000 is 91% of 75. You have access to 91% of what you put in. You could say you got back 91% of every dollar you paid for the car. And if this isn't making sense, I'm going to give you one more example to maybe clear this up for you. I'll show you one more time. Let's say year number 8 of this policy. He no longer wants to pay premium, so he stops. No more deposits. So we'll show you from year 8 to 12 what happens. No more payments, no more premiums. But he wants to buy a second car for his spouse this time or his kid. Takes 25 grand out again against his cash value to go buy this car. Again, he pays himself back just like he would pay anybody else. 6,000 a year, 5 years, like any car note. Again, total it up, $0 in premiums, 30K in loan repayments. He took out 25 to buy the car. So his net injection over that 5-year period is 5 grand. Put in 30, took out 25 to buy the car. He's put in 5,000 into this. And look at his cash value again. 91. His cash value grew from 67,000 to 91,000. His cash value grew $23,000. You put in 5 and it grew 23. So it 4x'd, almost 5x'd. And you bought a car. You made 23 grand off of buying a car. How is that possible? Remember, your premium deposits are going to sit there and uninterrupted continue to compound. Tax-free, risk-free, safe from the world, the market, the economy. You have a death benefit for your family in case something happened to you. And now you just bought 2 cars and made money off of doing it because you financed it yourself because you were the bank. In the first 7 years, he paid 75K in premiums, or 75K went into this. From years 8 to 12, he put in another 5 grand. So he put in $80,000 in that 12-year span into the policy. 80K went in, and his total cash value is 91. He made $11,000 net off of buying 2 cars. And there's 3 rules we implement when we do this. Rule number 1 is pay yourself first. He paid himself. He put this into his policy before paying anybody else that extra money he was saving. Rule number 2 is pay yourself back with interest. Rule number 3 is pay yourself back and recycle and recapture the interest to yourself. So if this works for a car, what else does this work for? Well, it could be anything. Could be, I don't know, house, taxes, a rental property, tuition. Anything you finance throughout your life can be financed in this method. Guys, isn't this amazing? I just showed you guys a hidden secret to building wealth. Who wished they knew this when they were younger? Who wished they did this the last time they bought a car? Or maybe who's going to do this the next time you guys buy a car? Are you going to do this the next time you pay Uncle Sam? Or you buy another home someday in the future? Okay. Thank you for the hand raising. I agree. I'm on board too. Let's finance everything through this method. And I'll give you one more example so you guys get more ideas of how this could work. Let's say you had a $23,000 line of credit, a debt. You had a debt with the bank for 23 grand at 9%, and you're paying about $300 a month. This is actually a real case study. He had the money in hand to pay the debt off. He said, should I pay the debt off in full? I hate the debt. I want to get rid of it. Or should I put that through a policy first and then pay off the debt? And he's like, well, if I do that, I think he said, I then have to pay my policy back, and I don't want to do that. I don't like payments. I don't like debts. I'm like, well, let me change your mind on that, okay? This is the diagram of what we showed him. So he put in $30,000 into his policy. He then took out 23 as a loan against his policy and went and paid off his line of credit. Now his line of credit is gone. He no longer has to make $289 month payments. So what's he going to do with that $300 payment that he no longer has to make? Pay himself back. Just recycle the money. He's just recycling it and recapturing the interest he was paying to somebody else. So put in 30, that 30 is now going to earn interest and compound the rest of his entire life. He's paying himself back 9%. He was paying somebody else. So he's now making money 2 times on the same dollars by running it through his policy. And he never lost his original principal. So this diagram is exactly what you would be doing. You'd be funding your policy, paying off a debt or making an investment or making a purchase, and then recycling the money back through into your own banking system. Another easier example might be an investment. You could invest in private money club, lend your money to somebody else in there. They're paying you 12% on your money, and you use the monthly income payments to just refill the policy and then do it all over again. The money just goes from the left over to the right and just recycles back in. Hopefully these diagrams are making sense.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
And guys, only one of 2 things are going to happen to us throughout our life. It's true. We're going to live and we're going to die. It's going to happen to every single one of you on here. It's going to happen to me too, and that's okay. So are we better off with this than we are without it while we're alive? Well, I just showed you multiple ways to make money twice on every dollar you invest, how to pay off debts and recapture it, how to finance things more efficiently. Yeah, you're better off with this than without. But remember, this is life insurance. So when you die, your beneficiary is going to get a large lump sum paid out to them. So your family's better off with this than without it. So I do want to mention real quickly, we don't charge people for setting up policies or teaching them how to use it. Don't you guys wish you knew this don't you wish you knew this when you were my age? Right? Don't you guys wish your kids would start learning this and implementing it as they're young adults? Don't you wish your parents started this for you guys? This is a family venture. And we're here to teach people how to implement this We're not the insurance company directly. We work with insurance companies, and we can show you guys how to build these policies and finance your lifestyle through it. How to maybe pay off debts if that's your scenario. Maybe buy rental properties if that's your goal. Whatever it is you want to do, you can finance it through your own bank, and that's what we're here to teach. And we're paid from those insurance companies for the business that we're bringing them. That's why it all works. Now we're here as a third party just to help make sure you guys do this right. And I know we've covered a lot today, so I want to highlight 3 things. We talked about how banks make their money, how they profit by leveraging your money. And so we are here to flip that script and become our own bank. And you now know that you don't need to be rich. Anyone can do this if they have the right tools and guidance. And with inflation and market uncertainty in the world we live in, family banking gives you the complete and total control over what you're doing in financing. If you want to have that certainty and control over your money throughout your life from here on out, then you absolutely need to set up a banking policy. And you can't get a banking policy from a regular insurance agent, your broke brother-in-law who sells insurance, your financial advisor. They don't know how to set these things up. You have to work with a banking professional like our team, like myself. So we're at the 47th minute here. We got about 13, we'll call it 15 minutes left. I have one more slide and then we're going to open this up to you guys. Questions, your thoughts, your situation you might have a couple questions on. So we got a few minutes for that. But last slide here. I just want to quickly thank you guys for being here and spending your Tuesday afternoon with us. If you guys want to implement this family banking system as I have, as Chris Naugle has, as tens of thousands of people in our community have as well, even some people on this webinar today are doing this strategy too, then let us know. We'd love to help you do that. This is my personal cell phone number on the screen. You can literally just shoot me a text. Send me your name, your number. Let's find some time to talk. I will help you. I don't know, if you want more resources, podcasts, YouTube videos, books to learn this, to have a better understanding, I'll send those all to you. If you'd like to have a meeting and a quick call or Zoom and go through your exact scenario, your numbers, we can do that today also. So the next few minutes, I'm going to open up to you guys to go through questions and answers. But I'm going to be here with you guys today, next Tuesday as well, and anytime you guys need. So again, shoot me a quick text and we can set up time to meet, or I can help you in whatever other way you need. But let's wrap up here with some questions. So we've gone through a lot. I already got a few questions in the Q&A. We got some hands raised. I will keep this shared up here. If you guys do want to set up time to meet directly, I'm throwing in the chat here my personal calendar link for you to set up time to meet. And so there it is right there. If you just have a question, you want me to email you some, I don't know, an answer or more resources or whatever, there's my email. And again, my number's on the screen. So we got 15 minutes here. What are your questions? Let's start going through them. I already have a few I'll start with. So Leah, you said, here, I'll pull up your question. Q&A, where is that? Actually, your Q&As were messaging me directly. So you wanted to know about your exact scenario with your personal line of credit. Great. Throw the details in here. Let's get your help. Shane said, I wish there was transparent companies out there like ours when he was younger. Me too. That's what we're here to do. You guys got to get your family involved with this so more individuals can start doing this at a younger age. Well, thanks, Anthony, for answering. What if I buy a 10K policy? I'm 78 years young, John said. I appreciate the young. That's awesome. You probably would be uninsurable, sadly, due to your age. But that doesn't mean you can't implement this. You could insure children, grandchildren, great-grandchildren, put policies on them. So John, I think that'd be a fantastic idea, is getting your family involved and setting this up for them. Okay. Somebody asked, is the car example good for used cars too? Sure. However you buy a car, same concept. The policy is just where your money sits before you go buy it. So as long as you're storing money in your life insurance policy, that's it. Your job's done. Now, anytime you buy a car from anywhere, anytime you invest in anything, anywhere, you're just using the money sitting in your policy to finance those things. Somebody said, why do you use 25 grand to buy a car? A car is going to cost you way more than that. Yeah, you're probably right. I mean, there's a lot of people who buy cars for way less than that, but there's also people who buy cars worth way more than that. So, I mean, your situation's your situation, man. It's just an easy example. What's the least amount of money you can start a policy with? I would tell you, a couple more questions coming in. I would tell you that the minimum you should do to make this work for you is if you can save at least 10 times your age per month, then that's what your premium should be at the bare minimum. You're 30, add a zero, $300 a month. You're 40, add a zero, $400 a month. That's the minimum you should do to make this strategy work for you. If you're only in a position where you can save $100 a month or something, then I would say go work on building your income, building your business, decreasing your expenses. Find a way to save more money before you try any financial strategy. Ford Sam, sweet name by the way, said, what is a great mutually owned insurance company? We work with a lot of them. So companies like Lafayette Life, One America, Mass Mutual, Guardian, Security Mutual Life, Penn Mutual. I know some people who use Emeritus as well. So tons of companies. Every single one of these companies are over 100 years old. Every single one of them is A+ rated or higher. Every one of them has paid a dividend every year they've been in business. So a ton of strong companies. What about someone living on Social Security and paycheck to paycheck? Again, if you're not in a position where you can save money, then there's no need to study anything with money. Find a way to make more. And whatever that way is, great. And as you're producing more income, then the question becomes, where do I put my money now? That's where this comes into play. Storing your funds inside your policy. So all future investing, purchasing, financing starts to come from your policy itself. Can you use a HELOC to start the policy? So, and real quick, Richard Davis, you said you joined late. Can you get a recording? Yes. Throw in the chat your email and we'll send it to you. So can you use a HELOC to fund a policy? Yes, you can. Whether that makes sense or not, very situation dependent and really math dependent. If you're going to take a loan from somewhere that you're going to owe interest and a payment to fund a life insurance policy, and then take a loan from your life insurance policy to put it back in your HELOC, now you still have a loan in your policy and maybe a little bit left over in the HELOC you have to pay off. So that's a lot of additional steps and additional interest you pay to other people for probably not much of a gain, unless there's a way for you to use that HELOC to go make investments or purchase rental properties that produce cash flow, and this cash flow you use to repay all these loans. That would work. But again, super situation dependent. And as you already can tell by the way I'm talking about it, there's so many hoops to jump through. Not my favorite thing to do. But there are some people who love that. So depends on your situation. What age is the latest you can set up a life insurance policy or purchase a policy? I would say once you get into your late 60s, it gets difficult. If you are very unhealthy, I'd say early 60s becomes difficult. If you are extremely healthy, early 70s. Is a medical exam required to set up a policy? Yes, it is. 90% of the time, you will need to get a medical exam. What's the age limit to set the insurance? There's no age limit. You could set up a policy on a baby, on a 2-year-old, 10-year-old, 18, 20, whatever you want. So there's no age minimum. So that's about 9. Awesome. So good questions. So I'm going through them now. Yeah, Anthony mentioned he uses a HELOC with his policy. Awesome. Glad you do. Fantastic strategy for some people. Recording for these two people. Got you. Got your emails. Another couple emails in here. Another few emails. Okay, so I'll send recording to you guys. A couple more questions before we finish up here. If we take out policies on key employees who have been with the company for 10 to 25 years, does that bond us for life? They're awesome, but I still want to keep it professional. Yes, you totally can get a policy within your company. Your company could own the policy, fund it on your employees. I think it's a fantastic idea. It could be in replacement of a 401k or any other benefits you offer your employees. It does bind you for life per se, but you could make it not. You could have the business, maybe you could do any kind of agreement you want with the employee. I've seen people do like you know how they do 401k matches? You could do a policy match where your employee puts some money and you put some money and you fund some policies, and then over 10, 15 years, maybe you hand it over to the employee if you wanted to. You could just teach them to be funding it themselves and have their own policies. The business could own the policy right or outright on their employees. You could do that too. So you get all kinds of options. I think it's a great idea, but again, it's super situation dependent. So that would be the case. And again, anybody who would like to set up time to meet to see how they can implement this strategy themselves, click the link. I just threw it again in the chat. And I think like someone mentioned, the site doesn't work. You have to put in www first or let's see, Carson.be your own banker. Yep. There you go. That doesn't work either. I don't know what you did. Somebody put it in here and it worked. Thank you, whoever did that. Throw it in here again. Okay. Awesome, guys. I will let you have a good rest of your day then. Come back next Tuesday. We'll keep talking about ways you can become your own bank.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.